This is Quint Bila with additional topics beyond cash dividends and stock dividends. So we'll be discussing the topics outlined here: retained earnings statement and certain analysis from the income statement. Just as a reminder, here's the elements that can affect the retained earnings account. We previously talked about cash dividends and stock dividends. It's important that you understand the transactions, how they're recorded for cash dividends and stock dividends. Both of those dividend types reduce retained earnings. Stock splits, as we discussed earlier, do not reduce retained earnings. They simply increase the number of shares outstanding. Where there were 200 shares, the corporation says make it 400 shares. Stock splits do not require any journal entry, although it does affect the par value of the stock. So what else goes to retained earnings? Well, any income increases retained earnings, or net losses decreases retained earnings. During the year, we're recording the results of operations in revenue and expense accounts, and those temporary accounts collect all that information throughout the year, even though we report net income periodically. But at year end, we physically close off the revenue and expense temporary accounts into retained earnings through an income summary account. So retained earnings is part of the stockholder's claim on the total assets of the corporation. It's all about earnings less any dividends that have been declared out of retained earnings. If a debit balance ever exists in retained earnings, it's identified as a deficit. This debit balance, which would be unusual, would prevent any ordinary dividends from being declared. In effect, a deficit balance in retained earnings at a point in time indicates a cumulative losses have been incurred by the business. As indicated below, if retained earnings is in a deficit or debit position, it'd be a deduct in the stockholders' equity section, not an addition. Normal balances in stockholders' equity would be credits. The retained earnings account can have some restrictions, either legal, contractual, or voluntary restrictions. It's important to note that any of these restrictions would be temporary. They would temporarily limit the dividend payments. For example, if a corporation borrowed some money from a bank, the bank might indicate that the corporation put a temporary restriction on the payment of dividends, meaning that they don't want the borrowings from the bank to be paid as dividends, but to be used in the business. Therefore, it's common that a large bank loan would carry the provision that the corporation receiving the funds temporarily restrict payment of dividends from retained earnings. Any such restrictions should be disclosed in financial statements. Examples indicated below on the bottom of the page. Prior period adjustments. This is a correction of an error in your previously issued financial statements, primarily referring to a previous year, resulting from mistakes in application of accounting principles, or other oversight of information. The key is that any adjustment is made to the beginning balance of retained earnings. We do not let prior period corrections of errors affect the current year's reported results. In effect, an error means that a previous period was misstated. We're not going to misstate the current year, finding that error later. An example of a statement of retained earnings. This is a statement that it covers a broad range of activity, but it's very brief. Net income, one number, no details. Want to know the details of net income? Go to the income statement for revenues and expenses. Statement of retained earnings, one number. Dividends. These are ordinary dividends coming out of retained earnings, having to do with some use of earnings, paying a cash dividend or a stock dividend. Now, what happens if we do discover an error as we're about to publish some financial statements, in this case here for the year 2014? If an error was discovered, $50,000 related to a previous year, 2013, when that error is discovered, we're not going to modify the current year's results. We're going to restate the beginning balance of retained earnings. So the January 1 balance of $1,050,000 would be restated for the error discovered in the next year, but before the publication of the 2014 statements. A further word on dividends. We've learned both cash and stock dividends reduce the retained earnings account. The retained earnings account exists to limit these amount of dividends that shareholders can receive, only to the extent that earnings have been accumulated previously. Again, these are ordinary dividends. Anticipates the corporation is a going concern, staying in business and using its earnings in some manner. Now, what if a corporation is about to close its doors? You can also declare dividends out of paid-in capital. These are the stock and additional paid-in capital accounts of the stockholders' equity section, amounts representing investments by owners. This type of dividend, though, is called a liquidating dividend. And it's only potentially done at the end of the life of business if sufficient cash exists after paying all other legal debts and liabilities. If a corporation is closing its doors, it may not even have enough cash to pay its existing legal debts, let alone declare some liquidating dividends to owners. So make that distinction between ordinary dividends coming out of retained earnings versus liquidating dividends coming out of other parts of the stockholders' equity, the stock accounts, additional paid-in capital accounts. I just want to summarize, again, the main activity flowing through the retained earnings account. Those activities highlighted in red would be part of the retained earnings statement as separate line items, either income or loss, dividends, cash or otherwise, and some dispositions of treasury stock. Treasury stock being stock that a corporation has reacquired off the market. If it resells it, and if it resells it for less than cost, that debit may be taken directly to retained earnings under certain circumstances. So the items in red would appear in the details of the retained earnings statement for the current year. Any correction of previous years detected in the current year will be reported as a restatement of the beginning retained earnings balance, not as part of the current year activity. Let's look at an example of a restatement of a beginning balance. While publishing the year 2014 results, if Woods Incorporated discovers a $50,000 error that belonged in a previous period, 2013, it would handle it in this manner. It would restate the beginning January 1st balance. So it would reduce that balance by $50,000 and begin with a corrected beginning retained earnings balance. This is an example of the error that was discovered, in effect, allowed an overstatement of the previous year's income. Any previous year income is closed into retained earnings and increases its balance. So in effect, if we find an error related to the previous year, we back it out of that beginning balance as if it never entered retained earnings to begin with. The rest of the detail in the retained earnings statement is normal activity associated with the current year. Net income of the current year, ordinary dividends of the current year. The key is that we do not allow the current year results of operations to include corrections pertaining to a prior year. They must be highlighted separately as a restatement of the beginning balance. For example, if any inventory of the previous year were overstated, the correcting entry, and it would actually be done by a journal entry, would be to debit retained earnings, credit inventory account. Review question. All but one of the following is reported in a retained earnings statement. The exception is sales of treasury stock above cost. Treasury stock sales above cost go to additional paid-in capital, not in the income statement. Items flowing through retained earnings generally are a result of operations. If we sell treasury stock, again, that was acquired off the market at a price higher than our cost, a corporation cannot report that as earnings. It cannot flow through retained earnings. Let's look at an example. Treasury stock, when acquired, the treasury stock account is debited at cost, cash credited. In effect, the corporation has used its corporate cash to buy some of its own stock off the market. That treasury stock account is not an asset. It's a contra stockholders' equity account in the stockholders' equity area. It shows, in effect, a shrinkage or reduction of the ownership of the corporation. Now, if the company subsequently sells the treasury stock, which it can, in this case, it sells it for $2,000 more than paid for it, it's going to book the cash coming in, $12,000 debit, increasing cash, reducing the treasury stock at cost, $10,000. The additional $2,000 in cash cannot be called a gain. It's additional paid-in capital dash treasury stock. That cannot flow through the income statement. Even though more cash was received by the corporation in its treasury stock dealings, that extra cash, in effect, is shown as additional invested capital, not as results of operations, not as earnings. Now, let's say it sold all of that $10,000 treasury stock at less than cost rather than more than cost, booking the cash, $9,000 debit, increasing that, reducing again treasury stock at cost, $10,000. If that was sold, it's got to come out of the books. But now they've received less money, $1,000 less than cost. That could be directly debited to retained earnings. In effect, the retained earnings account takes the hit for selling the treasury stock at a price lower than its original cost. Had there been a previous additional paid-in capital treasury stock account with some credit balance in it, that might absorb some of the losses from later sales. But if there is none, the debit all goes directly to retained earnings if the corporation sells treasury stock for less than the cost. Let's look at a recap of the stockholders' equity section. Let's look at all the permanent accounts that are reported in this balance sheet. Three main sections: a paid-in capital section, generic term meaning all of the owner invested capital as owners buy stock. Their issued stock in the corporation shows that evidence of ownership in the stockholders' equity section. So the paid-in capital includes both the stock accounts at par value and any additional paid-in capital in excess of par value if the stock was issued at a price greater than par value, which is common. Par value is generally a formality when it comes to a number. It's just a number. Market price and par value are not the same thing. Retained earnings section. This is the earned capital, results of operations, less any ordinary dividends paid to date. And finally, there can be a treasury stock section. If the corporation has reacquired some of its stock off the market, it will reduce the stockholders' equity section, indicating a reduction in ownership. Treasury stock is a debit balance. Normally, accounts in the stockholders' equity section are credit balances. Credit balances in these accounts indicates a positive number, that is a positive claim on assets on the other side of the accounting equation. In this example, footnote R indicates that some retained earnings is temporarily restricted, in this case $80,000. Let's look at a brief income statement presentation. This is a somewhat condensed statement. Even though detail is not given for the operating expense line, this would be called a multi-line income statement. That is, there's subtotals, meaningful subtotals, gross profit, income from operations, and other items. What I want to point out here is that there is a hierarchy of reporting in a multi-step income statement. That is, the items reported at the top are repetitive activity. Daily sales, cost of goods sold, operating expenses, coming down to a subtotal income from operations. This is what an investor would look at closely to see the trends of income from operations. Other items lower down in the income statement, other revenues and gains, other expenses and losses are less frequent and therefore not necessarily expected to recur every period. It's therefore are reported lower in the income statement. Let's look at some analysis of the income statement. there's a number called return on common stockholders' equity, simply a matter of net income available to common stockholders divided by the average common stockholders' equity portion. When I say average common stockholders' equity, we're looking at beginning and ending balances being averaged, excluding any amounts in stockholders' equity related to preferred stock-related balances. The ratio above shows how many dollars of net income were available to common shareholders for each average dollar invested by those stockholders, again, excluding any preferred stock balances. Let's look at an example. Let's say a corporation had net income for the year of $360,000 in total. From that, it paid $54,000 to preferred shareholders. So therefore, that available to common shareholders was the difference of only $306,000. Now let's say the total average stockholders' equity during the year was $4.5 million, beginning plus ending divided by 2, average stockholders' equity. And let's say that the preferred stock capital balances averaged $630,000 that are included in that $4.5 million. So we remove the preferred stock average balances, coming down to an average common stockholder balance of $3,870,000. If we simply take the $306,000 available to common shareholders, results of operations, divided by the average stockholders' equity related to common stockholders, we get 7.9% return on common stockholders' equity. The key here is that the amount available income is to the common shareholders, comparing it to the stockholders' average balances applicable to those common shareholders. That denominator, by the way, includes retained earnings minus any treasury stock that may be held. Another calculation, earnings per share, EPS, net income minus preferred dividends paid divided by weighted average common shares outstanding. This ratio indicates the net income earned by each share of outstanding common stock. Take a look at that ethics note at the bottom. Some managers, in case, engage in elaborate treasury stock transactions. Why? To boost the earnings per share. How does that boost earnings per share? Treasury stock holdings reduce outstanding common shares. So therefore, the denominator gets lower just by buying treasury stock. That would show a higher earnings per share just for that action alone. A point of emphasis on the last couple of calculations, return on equity or earnings per share. Please see that this is presented from the viewpoint of the common shareholder. That is, what's left over after preferred shareholders receive their dividends. Earnings per share is a common shareholder calculation not meant for preferred shareholders. Why? Because the preferred shareholder is interested in their fixed dividends. They have a yield on their preferred stock. That yield times the par value is the dollars per share the preferred shareholder expects in dividends each year. On the other hand, the common shareholder is more interested in the growth of the corporation. As the corporation grows, has more earnings, the common shareholders can participate in those through ordinary dividends, through common stock dividends. Preferred shareholders are limited to generally what the yield they sign up for when they buy preferred stock. Review question. The income statement for Nadine Inc. shows income before taxes of $700,000, income tax expense of $210,000, and net income of $490,000. If Nadine had 100,000 shares of common stock outstanding throughout the year, what is the earnings per share calculation? Let's assume that there are no preferred shareholders at all, so therefore there's no dividends to preferred shareholders. The entire net income belongs to common shareholders. The answer is EPS is $4.90 per share. That is net income divided by average common shares for the year of $100,000, or $4.90 per year. Rather, $4.90 per share for the current year.